I think the large thesis that we have here is if we really think about what our blockchain is being used for today, there are really two core use cases. One is facilitating like the settlement of speculation, i.e. meme coins on Solana or derivatives on Hyperliquid. It's just really like settlement for casino type activity. And I think the second one is actually settlement for stablecoins, digital dollars, and tokenization. And if you really believe the thesis of crypto, which is we're going to start to bring all of these financial assets on chain and finance moves on chain more broadly, you have to think that that second bucket that I just described there is going to be an order of magnitude bigger than this sort of circular speculative casino type of use case that we have today.
Hi everyone, welcome to Unchained, your no-hype resource for all things crypto. I'm your host, Laura Shin. We are now featuring quotes from listeners on the show. Today we have comments responding to my interview with Bitwise's Matt Hogan and Falcon X's Matthew Sheffield about the market turmoil and its impact on Bitcoin. On X, Frigg says, quote, "Strong fundamentals always take time to shine. Feels like the long-term play is still very much alive." Also on X, Amin Cad writes, "The real question is when does Ethereum begin to fulfill its potential?" To have your comment featured, write a review of the podcast overall, or leave a comment on our video on YouTube, X, or Farcaster. This is the April 18th, 2025 episode of Unchained. Bitkey is the Bitcoin wallet from the team behind Square and Cash App. It's the first 2 of 3 multi-sig hardware wallet with recovery tools that replace the need for a seed phrase. Get 20% off with code UNCHAINED. An AI that speaks crypto and does the work of a team of analysts. Introducing Focal by Falcon X, bringing clarity to a world of noise. Visit askfocal.com. Mintle is building the future of on-chain finance. Experience its enhanced index fund, Mintle Banking, and Mantle X. Visit group.mantle.xyz to learn more. Today's guests are Carlos Domingo, co-founder and CEO of Securitize, and Guy Young, founder and CEO of Ethena Labs. Welcome, Carlos and Guy.
Hi, Laura. Thanks for having me again.
Ethena and Securitize have both been very successful in DeFi, Securitize in getting institutions like BlackRock to build new products on chain, Ethena in creating this synthetic dollar with high yields that has garnered about $5 billion in total value locked. Together, both of your projects have about $10 billion in total value locked. A month ago, you two announced that you were launching Converge, which will be built with the Arbitrum tech stack with Celestia as data availability. I cannot say this, data availability layer. However, we just had an interesting moment here on the podcast, which we cut for editing purposes. I had in my initial intro that it was going to be a layer 1 blockchain because there was a lot of talk about that. And Guy and Carlos just informed me, no, it is actually a layer 2. Ethereum will be used as the settlement layer. So go ahead and just explain this setup and also why you think there was so much confusion around this.
The first thing I want to say is that from a user perspective, most people don't care whether it's an L1 or an L2 because there's really not the difference, right? You're using a blockchain and you rely on some underlying security for securing that network, and that could be done with an L1, creating your own set of validators, or it could be with a tech stack like Arbitrum that rolls into Ethereum and you rely on the Ethereum validation. When you use an additional stack to settle on Ethereum, you also have to secure that stack. And as you know, some of the L2s out there are not really decentralized. They have centralized sequencers. Our purpose is to build something which will look and feel like an L1, and it has its own security for the sequencer and then rolls into Ethereum for further additional security. And it's an EVM part of the Ethereum ecosystem.
Yeah, I think maybe just to touch on that in terms of how we sort of went through the decision process. And I think I agree with Carlos, the lines or I think sentiment towards like L1s versus L2s is going to shift quite a bit from now into the next few months, as I do believe that a lot of these like technology decisions are going to become somewhat commoditized for businesses or applications in terms of choosing where they want to go. I think the interesting piece of an L2, despite I think some of the negative sentiment that you've seen around them as it relates to like the way it interacts with ETH, the value accrual for ETH and all these different pieces, is that as a business, I think it still makes the most sense to be launching an L2 just because of the cost savings that you're making in terms of not having to manage a security budget for an entire L1. But but then also the performance that you can actually get out of them because you're not having to reach consensus at the L1 layer is obviously helpful if you're trying to run, performing applications that sit on top of it. So yeah, I think the decision that we made might have been actually slightly against the current sentiment that you see within the market now, where I think a lot of projects or different teams are sort of trying to chase this L1 premium that people perceive to exist within the market. But I think it's quite, we have a pretty firm view that if you're going to try build a business and have like product-led tech decisions to support that business, this made the most sense for the path we're going down.
Okay, so now let's just talk about your full vision of what activity on this chain will look like when Converge is up and running, because what you're creating is sort of a really interesting hybrid, trying to bring these two worlds together. So at least to me, I don't feel like there's anything that's been successful so far in bridging those two worlds. So what would be, your ideal of how this would look like?
So maybe I can start with that question. First, we just want to make something clear that this is a public blockchain that is permissionless. It's not. I listened to the interview you did with Arthur Hayes, where you guys talking about this is like an R3 type of thing. It is not like that. It is a crypto network that is completely public and open and permissionless. That said, RWAs by nature, they are permission assets because they represent securities and they're regulated tokens. And then, if you want then those assets to interact with DeFi, you also have to put some sort of permissioning around the DeFi protocols that today does not exist. Today, DeFi protocols are largely permissionless and anonymous. And this prevents the institutional adoption because, you have to think that maybe if you have an asset and you post it as collateral and you're borrowing USDC, you don't know who you're borrowing from, right? So if you are a large, financial institution and you're borrowing USDC and it turns out that USDC has been deposited in a pool by somebody in North Korea, then you run into all sort of problems, right? So I think that adding, by the way, all the, DeFi protocols, they understand that to go from the 100 billion or whatever is DeFi stack now to like $1 trillion, they need to bring more capital, and that capital needs to come from traditional institutions participating in this space. So at the same time, I think there is a lot of advantages on the permissionless and anonymous nature of some of the DeFi protocols in terms of getting things quickly done, and a lot of people do not care. So what we're trying to bring is both things. There will be apps that are permissionless and completely anonymous like the DeFi operates today, and then versions of those apps, like let's say Horizon that Aave is working on, that introduce some degree of permissioning to be able to interact with permission assets like RWAs, as well as for institutions to participate in a safe way.
Yeah. Maybe just to add to Carlos's comments, and I think the super high-level thesis, I guess, that we both came together with was, I think, a bit of frustration actually on my side in terms of the way that the cycle had progressed or the way that crypto had progressed since, 4 years ago in 2021. If we just take a step back and think about like what are the real sources of inflows that we've seen into the space, this cycle, it's really been only two sources. It's like BTC ETFs, and then stablecoin supply has gone up a bit for USDC and USDT. But if you look at DeFi TVL, it's actually down in percentage terms versus where we were 4 years ago. And to me, that's actually pretty indicative of the fact that we haven't actually done a very good job of actually positioning the space and the products that we're building for this amazing, thematic tailwind that we have behind the whole crypto, which is like institutions are actually here and trying to use these products and deploy capital into the space. So to me, that was just like a very strong indication that we had basically been shuffling around the same chips between Ethereum to Solana to Berachain, or like the same apps. We're just moving the same money around, and we hadn't actually stopped to think, what can we do differently to actually get real institutional size flows of inflows into the space more broadly? So that's something that like we at Ethena had been thinking about a lot and had been working with Securitize in terms of how do we institutionalize the product that we have. And I know this is something that we discussed on the last podcast that we had, Laura, and thinking about how do we wrap up what we do in a format that can actually be consumed by TradFi. I think the large thesis that we have here is if we really think about what our blockchain is being used for today, there are really two core use cases. One is facilitating like the settlement of speculation, i.e. meme coins on Solana or derivatives on Hyperliquid. It's just really like settlement for casino type activity. And I think the second one is actually settlement for stablecoins, digital dollars, and tokenization. And if you really believe the thesis of crypto, which is we're going to start to bring all of these financial assets on chain and finance moves on chain more broadly, you have to think that that second bucket that I just described there is going to be an order of magnitude bigger than this sort of circular speculative casino type of use case that we have today. And I think the view that we had was that Ethena and Securitize are really uniquely positioned to go and capture that second piece that I mentioned, because you have Ethena, one of the fastest growing dollar assets in the space, and one of the most vibrant, I think, DeFi ecosystems that exist within the EVM at least today. And then you had Securitize as the chosen tokenization partner for some of the largest financial institutions on earth, and the partner that they're actually going to be working with to bring more assets and more activity on-chain from TradFi. And so really it's like a meeting of the two, what we view as leaders of different ends of the spectrum, and trying to bring them together to create products in the middle to really benefit from those flows from TradFi.
Yeah, I love that description. I do really feel like that criticism is spot on, and kind of the vision that you have is probably a really good direction to go, especially at this moment in time. And I was just curious, you kind of mentioned that it seemed like you were hearing from institutions about what they would be interested in using DeFi for, or just in general, like how they would want to participate on chain. So what are they saying to you?
So I hear two things from institutions, and as Guy mentioned, we are probably the only company in the space that actually does tokenization for large institutions. Because if you look at some other of the RWA players, they actually have their own products, so they're not they're kind of playing to be asset managers. Our positioning is very different. We are a regulated entity that has a ton of licenses that can serve a large TradFi institution and bring it on chain. So we do have, I think, a better understanding than anybody else in the space about what those institutions are thinking. And there's two things that are interested in. One, they are interested in how can they access some of the crypto native yields that are sometimes better or higher than DeFi. And I think USDe is a really good example of that. But it will not be on the shape and form that is today, because for an institution to access it, you will probably have to have a regulated wrapper, some sort of intermediary like us facilitating transactions, etc. That's what we're working with Ethena. But they're also interested about some of the things they could do with their assets that DeFi will enable. And I'll just give you a very simple example. USDe has been very successful because it's an asset that when it was yielding much higher than the USDC borrowing rates, people could actually leverage it, right? You could post it on DeFi in a very simple way. You could, borrow with that as collateral, and then you can buy more and borrow more, and then you can go from like a 10% yield into like a 20% yield. This is what they call the loop, right? So why not do that with, let's say, a private credit fund? A private credit fund today yields higher, let's say like the ones we have with Hamilton Lane or Apollo, it yields higher than the borrowing rate for dollars, dollars on chain, stable coins. So you could think of the same experience, right? Like I posted it as a collateral. I buy let's say $10 million of these, and then I borrow 8 million, and then I buy 8 million more. I borrow 6, and then you loop it, and then you go from like the 10% yield into higher. And the entire process of the borrowing, as well as controlling the liquidation process for the collateral, is all on-chain automated. This is literally impossible to do with capital markets infrastructure. I mean, go try with your JP Morgan account and tell them, I $100,000 credit fund. Can you lend me dollars against it, and then can I buy more and then lend me again? And like this, forget about it. This is not going to happen. So I think they're very interested about how the value of their assets, when they tokenize them and they put them on chain, it's not just that they have a better ledger, but it's actually they can do more things with the assets than they could do before. And I think that's one of the reasons why tokenization is now a very exciting industry, as opposed to like when I started 7 years ago, where you couldn't do anything with the assets. There was no stable coins. DeFi didn't exist. Yes, you tokenize, you put in a token format, it's a better ledger, but that's it. And then today, I think the reason tokenization and RWAs are growing so much is because people, for the first time, see that it's not only a better ledger, it's actually the asset itself becomes a better asset because you can actually do things with it that you couldn't do before.
Yeah, I think that's exactly right. And I think from our perspective, one of the things that I think is going to be most unique about this chain and the way that we're actually approaching the application level was something that Carlos touched on earlier, around really thinking about taking the areas that Ethena has found product market fit building on USDe already. So applications like Aave, Morpho, Pendle, there's like a long list of them. We already know that like different applications sitting on USDe have found enormous product market fit for different use cases. But as just one example here, so I think Carlos gave the one with leveraging on Aave. I think another very good one here is like, let's say you're taking this iUSDe product that I described, and you're trying to approach these pools of capital within TradFi, and you say, here's a volatile interest rate that's moving up and down quite a bit. It roughly averages around 18%, but can go as low as zero. Some pools of capital would actually just rather have a fixed rate that you can provide on that product, which is essentially what Pendle is providing, saying we'll take a floating rate of interest and sort of swap it into fixed. That would be an amazing product with a huge amount of demand. But the problem is when you're doing this in a non-KYC environment, you don't know who the buyers are on the other side. And so these big institutions can't basically take funds from someone who could be a North Korean on the other side. So I think the really interesting feature of this chain is that you're going to have applications which will be permissionless in the same way that they exist within DeFi now, but they'll have just a button that sits on the top right-hand corner that says normal or institutional. And if you've signed up to actually be able to be involved within the institutional one, we'll have all of the guardrails that these entities need to face off on the other side. And then you already have things that make sense and have found product market fit around your core assets that you can then start to sort of export out in the right way into TradFi. So that's just really the things that we're trying to think through at the moment, which is not trying to create net new things that don't exist, that we're just taking a shot in the dark. We're saying what really works already with the core products that we have, and how can we deliver it in a format that actually makes sense for these people, and meet them where they are.
Yeah. This definitely, like I said before, just seems like a really an obvious opportunity and the right time for it. So in a moment, we'll talk about your most recent announcement, which is about the tech stack that you're using. But first, a quick word from the sponsors who make this show possible. Mantle is revolutionizing its on-chain financial hub. Powered by a $4 billion treasury and proven products like Mantle Network and METH protocol, Mantle is launching 3 innovation pillars: Enhanced Index Fund for optimized crypto exposure, Mantle Banking for blockchain-powered banking, and Mantle X for AI-driven innovation. Experience the future of finance with Mantle, and follow Mantle on X to stay tuned. BitKey is the only Bitcoin wallet on Time Magazine's Best Inventions list of 2024. Built by the team behind Square and Cash App, BitKey is a 2 of 3 multi-signature wallet and the first hardware wallet with an innovative recovery suite that eliminates the need for seed phrases in self-custody. Their new inheritance feature means BitKey's not just the easiest way to self-custody your Bitcoin, it's the easiest way to ensure it ends up in the hands of loved ones when it's time for it to leave yours. Learn more at bitkey.world. bitkey.world. Use code Unchained for 20% off. Picture this. The crypto market just got wrecked by billions in liquidations. You need to figure out what happened and what's next. But where do you even start? Meet Focal by FalconX, your AI-powered crypto analyst. It's like having a legion of experts at your fingertips, ready to break down market-moving events, chart DeFi protocol TVL, or explain why Solana mindshare is rising. Get clarity in a world of noise with Focal. Learn more at askfocal.com. We have another listener comment, this one responding to Matthew Sheffield's remarks on some of ETH's problems. On X, Uncle Sam of Afrinix says, quote, ETH isn't just some yield machine, it's infrastructure. If you're only in it for coupons, you're missing the entire innovation stack it's powering. Again, if you want to hear your comment featured on the show, please write a review or leave a comment on an episode on YouTube, X, or Farcaster. Back to my conversation with Carlos and Guy. So as we just mentioned, you guys have picked Arbitrum for your tech stack with Celestia's data availability layer. And I was wondering, when you said about searching for your tech stack, like what tech specs were you searching for, or what problems were you trying to solve with that?
Yeah, I can jump in, and then Carlos, obviously, add anything that you think. Yeah, I think for us, it's really trying to think about, we already have an enormous asset base sitting with Ethena at the moment and with Securitize. So I think you mentioned in the beginning, cumulatively between ourselves is around $10 billion. And being able to take the existing critical mass that we have into a new environment in a very easy way for users to be able to come across without a huge amount of technical debt was like a big consideration for us. So going to a new VM, anything else that was pushing the boundaries outside of the VM was something that we couldn't consider in the beginning, just because of where the bulk and the majority of our existing assets and applications actually sat. I think the second piece for us was just trying to get towards a tech stack that we felt worked out of the box now and was actually at the level of performance that we would require to run the applications that we needed right now. But B, was also able to be customized going forward for some of the needs that we required. And I think the main piece of like innovation that we're adding on top of the existing stack that exists now with Arbitrum, outside of like performance improvements, is basically this idea of a validator network that sits on top of it. The idea here is that you can sort of think about a sequencer that's running on an L2 at the moment as almost the most centralized or permissioned version of any execution environment that you could have, right? So a single sequencer sitting with Base and Coinbase ultimately is deciding are those transactions going through, and that's a single entity that's sitting on the other side. One piece I think in the conversations that Carlos and I have had with institutions is that there is some benefit in having some guardrails around something that looks like an isolated island outside of Ethereum, where if something were to go wrong with a hack, the wrong type of user is coming in who's doing something malicious within the chain. The real point of weakness is actually when you're trying to bridge out of the chain to say, we need to get our assets out of here and swapping into ETH to then launder it somewhere else. Being able to have a small validator network that actually sits at the bridge level, so in the case of like Athena's assets, they'll be sitting within a DVN on layer 0, actually gives them more assurances that if something were to go wrong on the chain, large institutions who are actually using the chain have an ability to actually step in post the fact of something going wrong before it's fully finalized on Ethereum. And so that's just one piece that we've sort of added on top, which is additional guardrails that these institutions can participate in by sort of like staking towards this validator network.
I want to add something about, moving, TradFi products on chain, because I think there's something people are missing, which is called transaction finality. So in finance, there is a concept that a transaction hasn't finalized until everything has moved, right? And of course, a blockchain actually tremendously improves that, because you can do, swaps of two assets without counterparty risk, instant settlement, and all that stuff. But the finality happens when you record it on the chain, right? So if you have an L2 that is completely centralized, that only settles the transaction when it writes on Ethereum, that only happens every 15 minutes. So at what point do you record the transaction on the books and the books and records of the actual financial institution doing it? When it settles on the L2 or it goes to the L1 Ethereum? And of course, everybody will tell you the L2, right? Because that's when people assume that the transaction is finalized and the tokens has moved. But that actually maybe is not actually truly secure yet, because it hasn't actually gone through the additional security. So being able to secure the let's say Converge on top of the security of then writing back into Ethereum, I think is a very important concept for providing, peace of mind to financial institutions that, there's finality in the transaction, the financial services transactions.
Okay, yeah. This whole thing about just the ways that this is structured, it's sort of like there's kind of a spectrum of centralization and decentralization that's on offer within the chain itself, which I find really interesting. And before we talk about the validator bit, which I definitely want to get to, I did want to just circle back to this part about the different apps, some of them being permissioned and some of them permissionless. And, Guy mentioned something like there was a button where, so like, let's say that you're in one of the permissionless apps and you decide that you want to interact with one of the permissioned ones. He said there's a button or something where I guess maybe that's where either you go through KYC, or if you've already offered your information, then you can, or if you've like uploaded it somewhere, then you can give it to this app. Is it something where each app is deciding like what information it wants? And then is it literally the same as like when you deal with the financial institution where you are handing over personally identifying information? Or is there any aspect of this that is more futuristic, that kind of uses ZK proofs or something where you don't have to give up the information, but you can still participate?
I just want to clarify one thing in terms of KYC and personal identifiable information, which maybe answers to some extent your question. Is first, we do KYC on people as a financial institution. We are a broker dealer and a transfer agent, but we never keep the personal identifiable information on chain. On chain, we only basically whitelist wallets to make sure that they're known to be safe and keep enough information to be able to determine the legality of the transaction. So, in other words, if you own shares of Apple and you want to send them to Guy, as far as both of you are approved market participants, you hold the shares and the other one can actually receive them, etc. You can just transact, and there's no need for anything to happen off chain. Everything happens on chain with smart contracts, and it's completely decentralized. There's no, but securities have constraints, right? Like maybe that you are, you have a lockup period for a year before you can sell the shares, or you there's a flow back restriction that shares sold to somebody in this country cannot flow back to somebody in another country. So you need to have some information about the characteristics of the investor, but not the actual personable identifiable information. So that is never on chain for security purposes. So you're not handing over your data and it shows up on chain and they know who you are, or a copy of your passport is there, or things like that. That doesn't happen. And I think this concept can evolve to create a better, if you want, on-chain attestation network that actually works for institutions. There is a lot of people chasing this concept that, I do KYC here, and then I attest that this wallet is valid. The problem is that if you interact with that wallet, assuming that has been KYC by somebody else, you're taking counterparty risk towards that company because you're relying on their KYC. So if that company is not a regulated entity, then that is completely useless. I can 100% guarantee you that our customers will not want us that we take, KYC that's been done by, some unregulated entity that is dealing with that. And many of these RW chains do that. They just, we do KYC. Well, you don't. Like you just have a tool to pass KYC. That doesn't know what KYC means. So
then basically for these permissioned and permissionless apps on Converge, each permissioned app will have its own way of verifying whether or not you can transact on their app. Is that it?
We want to make it uniform to Converge, that once wallets are whitelisted, there is enough information on chain for each app to determine whether they want to interact or not with that wallet. So not that every app is different. And then sometimes the problem is not the app. The problem is the asset. That's what people don't understand. You can design an app that will take an RWA as collateral and then borrow against it. And then whether you can actually move or not the RWA, or the RWA is something you can liquidate against another entity or not, it depends on the restrictions of the RWA itself. So the apps can actually be built in a generic way. And that's how we're working with, some of the protocols that we're kind of helping them on the design phase of how to make their products, their protocols compatible with RWAs. And then we, outside of the app, take care of the rest of the restrictions for the asset itself. So the restrictions are more in the asset level, and then the apps, naturally, because it's on chain, will inherit the restrictions or lack of restrictions of each asset.
Okay, so essentially, it sounds like from the user perspective, it seems like there will be a lot of friction because there won't be predictability around a number of things. First of all, whether or not any individual wallet can transact in these different apps. And then second, whether or not any asset that they would want to use. It sort of seems like they're kind of constantly going to be trying to figure out, will this work or will it not? Or
it doesn't have to have friction, right? So in DeFi, you also have pools with different assets, right? And you have the DeFi protocol is the same, but then each pool behaves maybe differently depending on the asset. So this will be the same thing. And then, if you are the holder of the asset, you actually know already what restrictions you have in terms of transferability or not of the asset. So I don't think that this will add friction. And by the way, the KYC part.
But then the user has to have an awareness of what all the restrictions. 100%. They have to keep it in their head. Okay.
But they do today as well when they buy RWS, because that already exists. So RWS, because of the nature of being securities and being securities with different characteristics, some of them are private, some of them are registered, some of them have different exemptions, some of them are different RWS for QP, some of them for accredited investors. They already have those restrictions in place. So that doesn't change from what we have today. And the KYC piece, which is another criticism I always hear, is people like DeFi because you don't need to do KYC. I just, because I've been long enough in the industry, in 2015, 16, you could open accounts on centralized exchanges without KYC. Yeah, it's true. I do. I do remember, I did.
That was 9 years ago.
Fine, 9 years ago. And then all the centralized exchanges impose KYC, some of them faster than others. But today, it's literally impossible for you to open an account in Binance, in Kraken, in Coinbase, whatever, without KYC, right? And what has happened with the volume? Has gone up or down? It has gone up.
Yeah.
So this perception that, KYC introduces friction and then nobody's going to use it because customers have to KYC, I think that's actually not true. You can also look at what happens in TradFi. To open a Robinhood account, you need to have KYC and how many users they have.
Yeah, my question was more around user experience rather than saying this isn't going to work. More just, I'm wondering what will it be like for a user who wants to just move back and forth, but like an everyday retail person, like that's the part that I'm wondering.
I'll tell you how we solve it in Securitize today, because this problem is a problem that we already have, because each asset that we have, it behaves differently. So if you come to our account and you have, let's say you create a Securitize ID, let's say in the case of Converge, let's say you connect your wallet to the chain. So you're connected to the wallet. Because that wallet has been whitelisted, the chain knows your characteristics as an investor. They know if you're retail or not. They know if you're a US or not. They know if you're an institution or an individual investor, because that's the non-personal or identifiable information that we inject on chain, right? Then you can actually have a UI that will only show you the products that you can interact with. And today, if you go to Securitize, that's actually what happens. Like if you go there and if you're an individual investor, you're not going to see the BlackRock product, BUIDL, because it's only for institutions. So it's a very simple filtering of, you're going to have a range of protocols, and the protocols, by the way, will work across all the assets. As I mentioned, the issue is the assets. So some assets are you will be eligible for some assets or for some other ones, but because that the eligibility or not depends on your characteristics as an investor, those things are visible to the chain. So it will not create friction, in the sense that it's not that you're going to go and see, I'm an individual investor and I see the BlackRock product and I want to buy it, and then I cannot buy it, because we will not let you see it anyway. This is exactly what happens on our portal today. You only see the products that you're allowed to purchase, because we know the characteristics of the investors. So.
Okay, yeah. So that sounds smoother. So let's talk about the Converge validator network. This is what Guy was mentioning about how, like, if there's some kind of big hack or something, then you can keep the funds from leaving the system through these different bridges. So tell me about, how many validators are there? Where on the spectrum from decentralized to centralized does it sit?
Yeah, it's not in the hundreds. It's like somewhere between 10 to 20 is where we'd originally planned to roll it out. Again, this is just supposed to be for the largest institutions that actually hold capital on the chain, to be a participant in that decision making if something were to go wrong. It's not intended to be something that's in the thousands or replicate like a validator network that you'd see on an L1.
Ethereum already has a very robust and large validator network, right? You just need to create another one that provides some degree of security temporarily while things are not settling to Ethereum, right?
And to understand, when they would intervene, are you guys kind of setting up different parameters for when it's appropriate to do that versus not? The $1 billion hack by North Korea is a very obvious one where most people would say, this is why some of the places like Thorchain and I'm just blanking on the other one, but there were other chains that got criticism for not intervening there. But, are you kind of coming up with a decision tree in advance, or how do you think about when they should intervene versus not?
I just want to distinguish between digital assets that are better assets and RWAs that are not better assets, because there is a confusion in the industry about it. So if you buy ETH, let's say, then it's a better asset, right? So the moment you send it to somebody, it leaves your wallet, it goes to the other wallet. There's nothing you can do. But, other assets like, let's say, stable coins, have a mechanism to freeze stable coins in case it's needed. And for RWAs that represent securities, the smart contract that governs that, obviously with all the controls, has the ability to actually freeze the asset or even burn the asset. So I think that the hacks, obviously something wrong can happen everywhere, but they can also hack your bank account and take some money. But in this world, it's because the assets are not better assets. It's actually a much safer world, and this is why institutions interact with RWAs, because the risks that they're taking are in a completely different level. So the degree of risk, and we've talked to regulators about this. Like when you are doing custody of digital assets, your risk is 90%, right? If the custodian loses the keys, or if somebody hacks you, then you can lose all the assets. When you're doing custody of RWAs, you don't have zero risk, obviously, because something can go wrong, but your level of risk has dropped to 10%. So.
Yeah. And Guy, you were going to add something there?
Yeah, I was just going to mention that a lot of the L2s already in production today have these concepts of security councils that sit around them, which are quite prescriptive, as you mentioned, around where they might actually step in for something going wrong. But this is more like the social level rather than something that's encoded into the chain. But yeah, it's a very similar concept here, where we'll just be adding an additional piece specifically as it relates to like the bridging in and out of the chain, which would be different between the different assets on the Securitize and Athena side. But yeah, it would look something that's not too distant from what you see from Security Council pieces that exist today. Yeah.
All right. I also wanted to mention another part of your announcement, which is Ethereal, your new DEX. And I saw that you said to ensure Ethereal can maintain high levels of performance at all times, Ethereal will sit on top of its own block space, but post proofs down to Converge. So it sounds to me like it's an app chain within Converge. That was kind of my read on that. But yeah, I'd be interested to hear more if I misunderstood or how it works.
Yeah, that's exactly correct. So I think perpetual exchanges are really one of the very few applications that make sense to really live as their own isolated app chains, in my view. I think the reason for that is that they don't rely as much on composability with different applications, i.e. you don't need a Uniswap pool there to support a perp DEX because it's already dollar denominated and synthetic on the exchange itself. And so your requirement for composability is much less, but then also your requirement for isolated block space, which is not being interrupted by the actions of other apps on the chain, is quite important, because what you tend to see is that when demand for block space is the highest is when things are melting down, there's chaos, people are getting liquidated, all these different pieces when gas spike. And that's the moment when people are trading the most and don't want to be interrupted the most while they're doing that. And so actually isolating an exchange and what is pretty heavy computational requirements from an exchange from the rest of the chain itself, I think is one of actually the very few examples of where isolated app chains make the most sense in terms of types of apps.
All right. So we're coming up on time. The last probably quick question I just want to ask is, people often talk about how institutional investors want privacy, and I didn't know if there was anything that you were offering in this regard, or if that's, further down the line.
That's a very good point. That's definitely on the roadmap, not for the mainnet that we're planning on doing Q2, because for obvious reasons, this is more complex to build. And that was also one of the things we like of the Arbitrum stack. I think that institutions will want to have some degree. Today is fine, to be honest with you. Like, it hasn't been a barrier for institutions participating in the space. But as this space grows, if you're going to take, let's say, a tokenized treasury fund like Biddle, and you are an institution and you're going to post it as collateral using Converge for derivatives tradings, etc., you don't want to see that people see that transaction once they identify your wallet, because then they know what you're doing in the markets, right? So introducing some degree of privacy for transactions, I think, is going to be important for the growth of the space overall. Do we need it today? I don't think so. I think today is growing very nicely, and tokenized treasuries, as an example, went from $500 million AUM in March last year when we launched with BlackRock to almost 6 billion now. So it's more than 10%, 10 times growth over 1 year. So I think that definitely is there. But I think that's an important feature for our roadmap in the future. 100%.
Okay, so as you mentioned, soon you'll be launching your testnet, mainnet in the next few months. And at that point, just one last question. Will the activity that both of your protocols have on Ethereum itself be moving to Converge, or will you leave the activity that you already have there and then just start building a new on Converge for Athena and Securitize products?
Yeah, I think on our side, we have no ambition to sort of like leave or abandon the existing activity that we have. There's not really like a rational reason for why we'd care about USDe sitting in one place rather than the other. I do think that we're looking at a slightly different user base. This whole idea of tailoring some of these use cases towards institutions just might mean that it actually is opening up, expanding the pie rather than actually just trying to fight for the same amount of dollars sitting on different chains. And so, I think it's a slightly different user base that we're facing off to there. I'm sure, some of the assets that we actually hold behind some of the Athena products. I think one example here is actually the Biddle product that we have with Securitize and Carlos. So like USDtb, I think, is the largest holder now of Biddle. And obviously, as like a centralized stablecoin, we can sort of decide where those assets actually sit. And so we would move if we have some of those assets that are actually, in control of like a centralized stablecoin like USDtb. It might be that we house that on Converge rather than on Ethereum. But we still want like USDe and most of our products to coexist on all chains. We just have a much more specific distribution channel and view of who we want to target on Converge. So I don't necessarily see them as like conflicting. Yeah.
I want to clarify one thing. our assets are not our assets. So we issue assets for our customers, which are the asset managers, right? So, and then there are investors that purchase those assets. So I cannot just go there and tell, you need to move your assets from here to there. And we support 10 different chains, and we're continuing supporting the other chains. They've been really good partners. We recently launched with Solana. We have a very long-standing relationship with, Avalanche, Polygon, and Optimism, and other people. That's not going to stop. I think perhaps Ethereum is the most like neutral place, because you are there as a default, but there's nobody behind that the decision of being there. And I think that the assets will move when people see more value of having in Converge, because we've built these, potential integrations or DeFi protocols where the asset can interact that might not necessarily be available in all the other chains. So, but as the guy said, I think that over time we will see natural demand of moving things over Converge, or just the new AUM and the new growth of the assets will accrue there alongside accruing in those places.
All right, perfect. Well, thank you both so much for coming on Unchained.
Thanks
All right, sounds good. Thank you very much.